Okay, hello, welcome to another session of Emerging Managers Program. My name is Nelson, your facilitator for today. I'll be discussing about risk equity financing. Now, I'm going to share a slide after this or in the course of the session, but I would like to really have your maximum attention. First, I want to ask, has anybody heard about risk equity financing or venture financing? You know, you've heard that term before. Anyone? Has anyone heard that before? Risk equity financing or venture financing in the past? Anyone, please help me. Okay, I want to believe that nobody has heard about this. Okay. However, I believe someone.
Sir.
Okay, go ahead, Deborah.
Okay, so I've heard of equity financing. So it's a little bit different from a loan in the sense that you kind of give a stake in your business to the person that is offering you this type of financing. So they kind of buy shares in your company, sort of, and then they have, whenever you have profits in the future, they get to share from it because they are stakeholders in exchange for funding for you for your business.
Okay. Thank you. That's correct. That is equity financing. We call it risk equity financing, but you could call it equity financing. You could also call it venture financing. Basically, it's a source of nature of financing where you get other people to invest in your business in exchange for the shares. Okay. And it might look simple, straightforward, but it is not. It is not at all. So let me just run through the slide and give you some slide background. So we have different types of financing. When you have the debt financing, you have equity financing. Debt financing is when someone takes a loan, debt, or when you buy treasury bills. In this case, you are giving the government a loan, or when you buy bonds, which could be corporate or government, you're also giving the government a loan. Or when you buy debentures are corporate bonds, essentially, when you're also giving a corporate body a loan. Now, that is when you, as an individual, some public limited liability companies can sell bonds, to the public. We call that debentures. You must have heard about Dangote raised a bond of recent. Can somebody Google that on your phone while we're having this session? Let me just want to make it as practical as possible. Dangote raised a debenture of recent. Can somebody check and let me know how much did he raise and at what price? Last year or last 2 years, Quick-Teller, that is Quick-Teller. Who is one of Quick-Teller? That's what are the others of Quick-Teller? Can someone remind me? Others of Quick-Teller.
Interswitch.
Interswitch, thank you. Raised a bond of recent. That was a year or two ago. Can somebody check how much did Interswitch raise and at what rate? So while we're having the conversation, I want you to give me those figures, please. So these are all debt financing. So corporate organizations can raise debt either privately from banks or publicly. So in other words, your company, any of you here, your company can raise debt in the future. So to do that, you have to to do public debt, not debt from bank. To do public debt, you have to work with NSE, Nigerian Stock Exchange, to register with them. You can register with NSE without necessarily going public. You can register with Nigerian Stock Exchange without going public, but for the purpose of raising corporate bond. It means that your organization is now being evaluated by third parties, that is the NSE in this case, to ensure that you have you comply with public disclosure, your finances are audited properly and on time, and you're telling the public the right information. Now, of course, you need to get a credit bureau to audit your books to say, okay, how credit worthy are you for you to take loans from the public? But generally, when you do that, it's cheaper relatively compared to somebody who is taking loans from the bank. Now, those are all debt financing. Equity financing is when you give somebody a stake in your business, or somebody gives you a stake in their business, in lieu of money or some level of compensation. Something is given. Now, we call sweat equity when somebody is not providing money, but it's okay. Okay, she said Dangote raised 116 billion naira bond. Fantastic. At what rate? When did he raise it, and at what rate? So said, in which year and at what rate did he raise it? So to provide context, 116 billion naira is about the budget of some states, so they can put that in context. So sweat equity is when somebody takes, let's say, for example, you say, Nelson, I'd like you to be the director of my company to give us advice. I can't pay you at this moment. I say, okay, no problem. But can you give me some sweat equity? So for that time I'm investing in your company, you can give me 10% or 20%, depending on how much value your company is worth. So sweat equity is basically equity you give to people in lieu of their contributions as individuals, not cash. So let's say you have a business you funded with your friends and family. You can't pay salary at that particular time, but you can give them shares in lieu of their contributions. We heard when Apple started, many of their founders, many of their young people got some stock. Those are sweat equity. So you could get people to give you free labor in lieu of stake in your company. That is sweat equity. Now you could get family and friends to give you investments. That's also sweat. So that's also equity financing. They're giving you this time around cash in lieu of stakes in the company. Now, if you have somebody who is not family and friend, just somebody that knows somebody that knows somebody that knows you, as an individual, can invest in your business and give you some money to have some shares in your company. That's angel financing. Like, we also have a big corporate, like there are different venture capital firms in Nigeria, which we're going to discuss. Those firms can also give you some stake, so some money for them to have some stake in your business. Now, the process of doing this and doing this right is what I'm going to discuss today in a nutshell. But before I continue, let me find out that you are following me. Farida, Karim, Namdshire, and Sheon. Any question before we progress? Thank you.
No, sir.
Okay.
No question for now.
Thank you. So, Deborah, were you able to get the rate for the loan that these guys took? Okay. How many percent? Okay. While we wait for Deborah to give us that, see what if someone to tell me how much InterSwitch took last time. So, in debt financing, the instrument for debt is, like I said, loan, bond, treasury bill. When equity, the instrument is shares. So she said Dangote took 11.85% for 7 years. That was a bond rate, 11.85%. So that's very low, right? Compared to banks, no bank will give 11.85. That's even below inflation rates. But the question is, why would somebody buy Dangote bond? Think about it. I should think it's another one, 12.35 for 10 years. Okay, question to the class. Ask yourself, why would somebody buy Dangote bond? Anyone? And why would Dangote sell a bond instead of going to bank? Any answers? Please feel free. Shout it out. All right, I want to say something. Go ahead.
I wanted to say, I don't even know what a bond is.
But we just described it. Now we say bond is when a corporate organization issues debt. So, for example, Dangote says, "I need £1 billion," for example. And they said to the public, come and subscribe to this debt. Come and give us your money. But okay, let me backtrack a little bit. Please, Deborah, also help me chat up Jeremiah. He was here before. He's gone. I don't know why he left us. Let me backtrack and see if I can describe to you what a bond is. Okay. Hold on. Give me a moment. Father, can you see my screen? Hello, Farida, can you see my screen? I want to discuss what a bond is. Can Farida see my screen? Or can someone else see my screen, please?
Yes, I can see your screen. Okay,
Yes, I can.
Thank you. We're discussing what a bond is. So, okay, so let's say Dangote is the company. Dangote wants to take a loan. Dangote can go to a bank and say, "Give me a loan." Dangote can go to the public, and say, "Give me a loan." When Dangote goes to the bank, it is called loan. Abi? Is that clear? Does that make sense? Gentlemen, if you answer me faster, we'll move faster. Does that make sense?
Yes, sir. It does, sir. It does.
Now, when Dangote wants to go to the public is you and I, or to, other investors for a loan, not for a equity. Remember, loan. He's going to the public for loan, not for equity.
Okay.
When he goes to the public for loan, it is called a bond. When Dangote goes to the public for a loan, it is called a bond. When Nigerian government goes to the public too for loan, it's also called a bond. But a corporate bond, Dangote is a corporate organization, different from FG, who is public. Abi, are you with me?
Yes, sir.
So this Dangote is usually called a debenture. So you could hear that Dangote issued a debenture or issued a bond. It's the same thing they are saying. But you don't use the word debenture for federal government. So federal government, you have a bond, could be a treasury bill, or you just hear the word bond, So we just heard that Dangote issued 116 billion naira bond. And I was asking a question: why would Dangote issue this bond, and why would you even buy it, assuming it was issued? That's the question we asked, and somebody said they don't know what a bond is. So Farida, I believe you know what a bond is now. My question now is, why would Dangote issue 116 billion naira bond, and why would the public buy it?
Because they hope to get an interest in the future to come of his shares or something.
Okay, the public is buying it because Dangote is paying them interest. Makes sense.
Okay.
Now, to think about it this way, if you have money, most likely you're going to keep that money in the bank. The bank is supposed to pay you some interest, but most times Nigerian banks don't pay you more than 5%, right? Even when you go for fixed deposit, the maximum you can get is maybe 8%. Abi? That's 8%. But if you have a corporate organization like a bank that is willing to borrow that same money from, so like a Dangote, you might get a better rate. In this case, Dangote is offering 11.3% or 11.6%. So you see, in the debt market, I want to be sure that I'm following. In the debt market, your bank is competing for you to give them savings, right? Corporates, but mind you, the bank is taking that money to borrow to corporates. Corporates are saying, instead of you to put 8%, to get 8% from your bank, why not come to us and we'll borrow it to you straight? Sorry, why not come to us and borrow to us straight and give us I'll give you a better rate. So Dangote is competing with the bank for that money that you have, right? Now, what Dangote is competing with, the federal government of Nigeria is also saying, give us the money too, we'll give you a better rate. So can somebody find out for me, what is the coupon rate of Nigeria's treasury bills? What is the last one issued? This I'm just mentioning. These are things that you have to go and read more about. So don't assume that you don't know the whole thing. So can somebody find out what the current treasury bill and what rate is the government issuing? Thank you. Mind you, our discussion today is on restrictive financing, but we have to discuss debts for it to make sense to some people. Coupon rate, treasury bill, we're waiting. Just you guys are very smart people. Google on your phone, give me feedback, please. I'm waiting. What's the current rate at which FG, that is Federal Government of Nigeria, is taking borrowing from the public? Now, these rates are important because if you want investments from people, you should note that those people have options too. They can go and buy Dangote's bond or buy federal government's bond, or even buy state government bond, or even buy UK government bond. Why would they invest in your company? Any feedback on this treasury bill?
For coupon rate, Nigeria, central bank rate is 14%.
Fantastic. Now, we now have 3 competitors here now. Come in, let's be sure this is big enough. Okay, good. So we said Dangote has 11%, Abi, and 13%, Abi. Good. Federal government is buying at how many percent you said? 14%. If you get bank rates, by bank rate I'm referring to fixed deposit, Abi. There's about 8%. All these are debts. So if you went to Dangote to say, Dangote, I want to buy your debt, assuming there's an issued debt by Dangote, the one they have at the moment is this amount. At the moment, FG is buying at So these things, they vary. At the moment, bank rate is buying at 8%. So most likely when Dangote sold 11 points and 13%, most likely FG was below maybe 10% then, because it's unlikely that FG will be 14% and Dangote will sell at 13%. Does that make sense?
Yes.
Good. So for Dangote to be able to sell, he must beat bank rates, because which one is more risky? Dangote or the bank? Which one is more risky? Assuming you have 100 million to give. Dangote is more risky, right?
Yeah.
That's it. So you see that somebody will prefer to, at the level of risk, you can assume that this is the less risky because it's your bank. Most likely they may not, it just maybe 6 months, followed by the government and then Dangote. So you feel that the rates will also vary accordingly.
Yeah.
So I've already introduced an element in this conversation called risk. Never forget it in finance. It's always about risk and risk level, So, and I've also given you that's competition. So all this is debt. Now, assuming now, Dangote now says, come and invest in Dangote, not borrow Dangote money. There's a big difference. Come and invest in Dangote and buy shares of Dangote.
Yeah.
That is investment solicitation. In business law, you've been taught that Dangote is a PLC, right?
Yes.
What does that mean? Can you remember?
The full meaning of PLC?
Yeah, I mean, the implication of being a PLC.
Okay.
I remember.
You see that this whole thing adds up together, right? Every bit of this information we are giving you is one piece. We're just broken it down, but you need to get the entire picture. If not, you will not have a good outing. So Dangote is a public limited
company. Yes.
It's a public limited company.
Yeah.
Does have a business name? But he has a business name.
No, what the unique thing about, when you guys talk, I'm going to see how far you are from the equation, and it will really affect you, because if you're discussing with your boss or bosses, they will not, it's difficult for you to get value if you don't know some of these basic things in business, because all of you are going to work in a business setting. So please, everything we are saying, just know that this is just 1% of the entire knowledge. So Google, be writing it down and go and research it. Believe you me, it will help you. Surely, if you want to become a manager of repute, not even to own a business, even at a management level. Okay, so let's say a public limited liability company is a company that its shareholdings are available to the general public. Abi? If you remember,
yes,
available to the public. Yeah.
Yes, sir.
But a private limited liability company has a limitation. It's a 1 to 50 max, right? So I cannot go now. I don't have a public limited liability company. I cannot come now and say, come and invest in my company. Come and invest in my company. I will give you, come and, I cannot solicit to the public a limited liability company, that is me, cannot solicit to the public. Do you know why?
Because there's a limited partner.
Who is saying that? Don't be afraid. Just say your name. Is that Namdi Bacho?
Yeah, yes, sir.
Okay. Yeah. The reason why you cannot sell, and anybody else with another idea? Anybody else? Why you cannot sell to the public? Why a limited liability? Why a private company like mine cannot sell to the public? Any other person? Hello, Stephen, you are in this class now. We're talking. You guys should remember this is not part of our course for today. This is just
Because it's like a
why. Go ahead,
Okay.
Namdi. Go ahead. Go ahead.
Because I'm thinking because limited liability partnership is like a merging of.
No? Okay. The reason is that it's a private company. By law, it cannot sell to more than 50 persons. But the real reason is that for you to become public, there should be a public authority overseeing your books. Do you understand? There must be, because if there is misrepresentation, you can walk away with people's money, right? And that public authority is the Nigerian Stock Exchange. Does it make sense now? Does it make sense, class?
Sir, please come again. I was lost in the.
I lost you too, sir. Like at some point. I did we-
Let me know. Can you hear me now, people?
Yes, sir. Yes, sir. It's clearer.
Now, the reason why a private limited liability company, like your company, cannot solicit to the public is that for you to solicit to the public, you must have a public authority as a public entity overseeing your books. Do you understand?
Okay.
And
Okay.
if there's no authority overseeing your books, we cannot trust that the information you're providing is transparent. There could be issues of misrepresentation. And that authority is called Nigerian Stock Exchange. So if your company now, let's say before Dangote went public, Dangote was a Dangote private limited liability company, Abi? Before.
Yeah.
Dangote now want to NCE. I say NCE, I want to go public because I want to sell shares to the public. Abi? My goal
Yes,
is to sell shares to public. Okay. And I just took it to me, fantastic. To do this, we must have up to 500 million turnover, for example. So this is an assignment to go and read up Nigerian Stock Exchange and what it takes to subscribe. Deborah, remind me to share a document on this on the platform. Deborah, are you there? Okay, Namde, remind me.
Yes, sir.
So
All right, sir.
they say,
Yes, sir. I heard you, sir.
Okay, 500 million turnover. They say, okay, you should have audited financial statements quarterly. We know what a quarter is, right?
Yes, sir.
You should have a board composition, as independent board, though, not your father, your sister, or your board. Independent board. And then an independent auditor. But this makes sense, right? So when when this company now says we have asset base, so tomorrow they make a claim. We have asset base of 100 billion naira. We have turnover of 250 billion naira. If they have met this A, B, C, D, right? We can now assume that this is a true statement. Abi? So the public can make informed decision. Does that make sense?
Yes.
So you see why you should not invest in all those come and invest, come and invest, come and invest. Because in Nigerian law, it's a crime. So if anybody that has gone through this course goes to invest in all of those things, your stupidity is, due, you get because you have, and you lose your money on those platforms, God will give you double punishments because you now know. Because those are public solicitation. They're soliciting for public funds, whereas they don't have a public supervision structure. So every company that must go public is going public because they want to access public funds, either as debt or as equity, right? And to do that, you have to give up autonomy. You have to give up something. And what do you give up? You give up your privacy. Just as someone that wants to get married. To get married, you cannot be saying, knock before you enter. You don't have that, you don't have that privilege anymore. Anybody, the party that has married you can enter at any time. So that's how it is with going public. If you go public, you lose the autonomy of saying that my records are my records. No, in fact, you have reports not just every year, every quarter. So Q1 you report, Q2 you report, Q3 you report. So let me give another assignment. While we're still having this conversation, can somebody go and get us the Q1 report of Dangote Group? Q1 report. Now, this is how you do this learning that we're discussing. You have to be doing practical. And you do it practically with available information, which is all available on the public space. So someone should try and get the Q1 report of Dangote. Someone else should try and get the Q1 report of Tesla. That person should try Q1 report of Apple. So every company that you know about today are public companies, and by law, they are mandated to report their financial statements publicly every quarter, so that people who are buying their shares or buying their bonds, that is debentures, are making informed decisions. So Farida.
So sir, can I ask a question, please?
Yeah, go ahead, please.
So the only way to know if a company is public is by the addition of the PLC to the name of the company?
Well, yes. And then if they are listed on the stock market of the country that they're operating in.
They are listed up in what?
They are listed on the stock market of the company they're operating in. Because when stock market now is, for example, Nigerian Stock Exchange, right, is the organization that does that independent check. That agency has a platform that we call the stock market for every country. And that stock market is where you have the repository of listed companies. Does that make sense?
I'm trying to.
Okay, just know that every stock market has a list of companies that are listed, every public company on it. So what do I mean by that? A company might be public, but not listed. You know, I said that earlier. A company might be public but not listed, meaning that I can go to the stock, I can go and register with NSC today. But I don't want to sell shares, because I can sell shares to the public. I can also sell debt. So if I want to sell shares, I have to go to NSC. If I want to sell debt, I want to sell to NSC. I have to sell to the public, right?
Yes.
But let's say I want to sell only debt and not shares. So NSC will not require me to come to the stock market.
Okay.
Because I'm not selling my stock. But I'm coming.
But it is still public.
Yeah, it's public because my information is public.
Okay. Okay.
You understand?
Yes.
My information is public, and that is statutory public by statute. It's not if I want to. You get? By law.
Yeah.
I have to publish those information publicly. And it's only on that basis I can now raise debt. So in every national stock exchange, there is the stock market, the equity market, then there's the debt market. So if you go to Nigerian Stock Exchange today, you see stock equity market, you also see debt market. Does that make sense?
Yes, sir.
I can be on both. I can only be on debt or stock at every point. And I've told you why a company might want to sell debt, because that company is likely to get a better deal from the public than going to a bank directly. But of course, the process of going to raise public debt is not so easy too. You know, that sometimes a company might prefer, let me just take a loan from my bank. It's not too much money. But if a company wants to take a little big money, they can go public and take the money from the general public. So any question? We took all this course because Farida said she wanted to get more information on what a bond is. So Farida, are you clear now?
Yes, sir. Just one last question. Can I be on both? I think you said something I didn't catch.
I said it can be on both bond and debt. I mean, okay. It can be on both equity and debt.
And debt. Okay. Thank you.
Yeah. You're welcome. So are we together?
Yes.
Okay, let's continue.
Yes, sir.
Let's continue with our session. Okay, so we stopped at saying that the instrument of debt is loan, bonds, treasury bills, but the instrument of equity is shares, right? So in a debt, you have to present collateral to the lender. But for equity, there's no collateral. So if I'm going to raise money from the public, it means that Dangote has put, for that 110 billion, Dangote has put maybe some assets, you know, and put that asset under a custodian. The custodian holds that asset and now issues Dangote's debt. So the public knows that this debt they are taking is protected, that no matter what happens, they will not lose their money. So someone says, is there a possibility of financial statement being doctored to secure public sympathy? That was a question by Amowa Stephen. So now, that's a good question. Stephen is not saying, it means it's just by writing financial statements. Stephen, I want to hear that from you. Speak up, let me hear you. So you've asked a very important question. On your mic. Okay. Stephen, I want to hear you. Here, I want to hear you. Are you in a crowded place? Okay. So Stephen was asking, is it just by writing financial statements? I said, wow, you're welcome to the world of corporate finance. Yes, it is by writing beautiful financial statements. Have you heard about Enron? Okay, since the environment is noisy. Has anybody heard about Enron?
No, sir.
Jesus Christ, you guys are the new generation, newly printed generation. It's as if you just came out from the womb. You don't heard about Enron? Okay, Google it. I'll wait for you. Enron. Because there's no need for me trying to rush if the foundation is not even there, right? So Enron. Can somebody give me? Karim, I have to mute you. There was so much background noise from your end. So I was asking, what did you see when you typed Enron? Anyone?
It says it was an American energy company
Okay.
based in Texas.
You didn't see Enron's scandal?
Error scandal, sir.
Yes,
So
sir.
what,
I see.
so what did you see?
just-
Can you just do any small read up on Enron's scandal?
Okay. He said it was one of the fastest growing and supposedly innovative companies in the United States. However, the entire edifice was based on a massive accounting and corporate fraud that eventually came to light and resulted in the Enron declaring bankruptcy in
Thank you.
2001.
Thank you very much. Enron was even building a massive energy project in Lagos State. So it was not as if it's a far subject. Enron was building something in Lagos State, was building a power plant in Lagos State as far back as 1999. So when they came down in 2001, of course, the project went bazooka. So the summary is that Enron is an example of what everyone was asking about. Is it possible for a company to cook her books and make money? The answer is yes. So in the world of corporate finance, everything is about reporting, financial reports. And this financial report can be cooked. That's why the Nigerian Stock Exchange and other public organizations ensure that we have independent audits. So an independent auditor knows that if whatever comes out that they didn't do the right job, they will lose all their pedigree. Which is why, if you want to raise finance, for example, today, you say, I want to raise 1 billion naira now, for example, and you go to, let's say, Afrexim Bank, for example. Afrexim Bank will say, go and get either KPMG, PwC, Ernst & Young, or let's say, Boston. What are those guys in Boston? You go and get them to do your numbers. The big four. Okay, can somebody tell me the big four are KPMG, PwC, Ernst & Young, and Okay, I've forgotten the fourth one. These companies are the big four simply because they have a reputation to lose. Do you understand?
Deloitte.
And Deloitte. They have a reputation to lose. So if a bank wants to finance you, they ask you, go and get the big four to do your numbers. So if they want to raise money now, and that's what you tell them, go and get the big four to do your numbers. Because these guys know that if tomorrow it comes out that they are lying, the whole world will lose confidence in them, and then the business will go berserk. So because of that, they will likely not tell a lie. But you see, it's an imperfect world. But the reason why you have to understand this is that if you don't understand this, you won't even know how much of a quicksand that you're standing on, right? You might just think that you are living in heaven, whereas you're not living in heaven. So the world we are living in is based on trust. Do you get that? The business world is based on trust, checks and balances. That is what creates this whole utopia that you are seeing. And if you don't understand it, you won't even know how to thrive. You think it's about hard work. It's not so much about hard work. It's about understanding the system and being able to create structures within that system. Does that make sense?
Yes, sir.
So Dangote couldn't have become Africa's richest man if it didn't go public. Which is another conversation altogether. How it is that going public gives you multiples. Now let me give you a case study. I like this study. I hope you guys are giving me your full attention so that I'm sure that we're making the highest, we're getting the best value from this exercise. So let me give you another case study that might interest you on why it's important that you understand these numbers that we are, okay. So let me use this instead. Okay. So let's say, tentatively, that, let's say Nnamdi Limited. Nnamdi, are you with me? This is your company now.
Yes, sir.
Your company makes sales of 100 million per annum. I'm not enjoying this board. Let me stop this board. Let me use another board. Let's say your company makes 100 million per annum sales. What do you think? Let's estimate what might possibly be your profit margin, right? Let's estimate what possibly will be a profit margin. And then what do you think can be a profit margin if you make 100 billion sales? So 100 million. What do you think be a profit margin?
I can't even tell, sir.
Yearly. Just give me a number. 100 million yearly.
Yearly.
Profit.
On 100 million sales?
Yes.
Yearly.
Hello?
Yes, I'm hearing you. 100 million.
Sorry.
Now is the fastest. How much profit in a year? Net. This is net profit.
Maybe 15 million.
Okay, thank you. That's a good number. 15 million. This is Nnamdi's profit yearly. Let's assume that Nnamdi's asset base is. Can you give another estimate of what you think might be his asset base? Example. Why I want you to give me these numbers is that I want you to think along with me. What can be his asset base?
Let's say the asset base is
50.
Fantastic.
No,
Fantastic,
okay.
Farida. Good thinking. I like that. 50 million. So in other words, if you sell the property that Nnamdi has and the current asset at any given time to give you 50 million naira, but this asset is able to turn it around 2 times a year, right?
Yes,
to get
sir.
100 million naira profit. But 100 million sales, and then make a 15 million profit. Good. In other words, someone could say that Nnamdi's returns on his investments is what now? %30%, right? Yearly.
Right.
In other words, Nnamdi is making 30% on this 50 million, Abi.
Yes,
Every
sir.
year. Fantastic. He's making 30% good. So this is Nnamdi's business. Fantastic. So Nnamdi has many options on how to grow his business. Nnamdi can say,
So you're
I
breaking.
have, okay, can you hear me now?
Yes.
Yes, sir.
Okay, Nnamdi has many options on how to grow his business. Nnamdi could say, I want to borrow an extra 50 million, for example. So he has 50 million. He borrowed another 50 million, Abi. He now has an asset base of 100 million. You know his sales might multiply by 2, Abi. You know it's possible, right?
Yes.
So if his sales multiplies by 2, it makes 200 million sales. What will be his profit this time around? Gross is a 30 million. Let's even say everything multiplied by 2, right?
Yeah, 30, yes, 30. Yes.
Okay. But Nnamdi has to pay the interest on this loan, Abi.
Yes.
Yes, sir.
So let's say that interest is, let's say, 30% again. Let's say the bank is charging, let's say 20%. 20%. So Nnamdi has to pay the bank 10 million, Abi, every year.
Okay.
So Nnamdi's real profit now will be, that's 20 million, right?
20 million. Yes, sir.
That makes sense, right? Good. But remember that even though I said his asset base has increased by 100 million, what I'm actually saying is that he still has his 50 million assets, but he has a debt of 50 million, right? But
Yes.
But on this 50 million, he's paying 10 million every year, Abi. So you can see that now just total investment has increased to what now?
To 50 to
40%.
40. Yes.
Yeah.
Yes.
Because
yes.
he's now making 20 million on 50 million.
20 million. Yeah.
Good. So Nnamdi is going to make more money if he takes debt, provided that the debt is less than his internal total investment. But this debt is 20%. If this debt was 30%, Nnamdi will not make an extra profit. True or false?
True. Well, if the debt
But
was
if-
30 million.
If the debt is beyond, if the debt is above my profit.
No, I said if the interest rate on the debt was 30%, for example,
Okay.
it means that he would have paid 15 million naira on the debt every year.
Every year.
And that will bring his profits down to 15 million naira still. Even though he has sold 30 million, 2 times what he was selling before, and made gross profit of 2 times what he was making before. If his interest
make
payment,
profit.
I mean, he made profit, but it will still be what he was making last year, right?
Yeah, I will be stagnant,
Increase.
kind of.
There will be
It
no
stagnant.
increase.
There's no increase. So now they have to ensure that his interest rate must be lower than his internal returns rate.
That's the rate in which he's paying the bank.
Yeah, I mean, the interest rate is which he pays in the bank must be less than what his business is making per annum. If not, he shouldn't take the interest rate.
Okay.
Do you understand?
Yes, sir.
So if Nnamdi is making, that's why as a business person, you should know your numbers. If Nnamdi is making 30% per annum, he's sure of 30% per annum, even if it grows by time, he's still going to make 30% per annum. Nnamdi is always safer. It's always safe, even if he takes a loan, right? As long as that loan is less than 30%. If it's 20%, if it's 10%, better for him. So the lower the interest rate Nnamdi can take, the more money he can make. That makes sense, right?
Yes.
Good.
Yes, sir.
Now, but the question now is this. Nnamdi's interest, Nnamdi's loan, Nnamdi's ability to take loan will always be limited by Nnamdi's current asset base.
True.
Remember that his asset base is still 50 million.
50.
So
Yes, sir.
if Nnamdi comes to the bank and says, "Bank, give me 100 million," bank will say, Nnamdi, what will you characterize it with now?
True.
Yeah. So Nnamdi's ability to take a loan is limited. Loan
So
is
he has to
limited.
increase his asset base.
Thank you. Nnamdi's loan is limited by his capacity to collateralize
Okay.
his
Yeah.
loan.
Yeah.
Remember what we said earlier that each loan must require collateral, Abi?
Yes.
Yes,
Yes.
sir.
So Nnamdi is doing a good business. So if he takes more loan, he can perform and make more money. So as long as the loan is less than his internal rate of returns, right? But Nnamdi is limited to how much loan he can take by his asset base. So Nnamdi is now looking at how do I increase my asset base? That becomes his chief headache. Because if I increase my asset base, I can take more loan.
Yes.
Yes, sir.
Before we continue, does it make sense? I want to show that I have
Yes,
everybody on board.
it does.
Yes, sir.
It does, sir.
Okay, thank you. So how does he now increase his asset base? The only way he can increase his asset base is to look for other third parties, or he can increase his asset base by reinvesting his profit. So every year he's making 15 million, he can be reinvesting that profit, Abi. That's one way to increase the asset base.
Okay.
One. This is what you call organic growth. Have you heard of this before? Organic growth.
No.
No, sir.
Okay. It basically that a business is growing by just reinvesting their profits. But it's good to know that this organic growth is geometrical. Let me give an example. Nnamdi at year 1 had 50 million, Abi. At year 2, they have 50 million plus
50 million. 50 million.
That's 65. At year 2, they have 65 plus, that is 30% of 65. It's about 19.5. Abi? He has 84.5. Year 4, he has 84.5. 30% of that is about, let's say, almost 26.
Managing.
Sorry? Hello?
Where, sir?
Okay. So you can see that he's not growing by 15 million every year. He's growing at more than that because he's reinvesting that profit, and that profit is getting money at the same level of returns, right?
Yes, sir.
Okay. So he had 15 million. So in 1 year, 1, 2, 3, 4. So in 4 years, he's getting like almost 3x, Abi?
Yeah.
Right? 3 times his initial capital, Abi?
Mm-hmm.
Yes, sir.
Good. So this is not bad. Organic growth is not bad. It's not bad. This is just 4 years. It means that in 10 years, it can multiply. So let me bear with me a little bit more. Let me just do. Let me see if I can. Let me see if I can. Let me do a small Excel sheet here. I always like putting things in Excel. Okay. I want to share my screen. Let's leave numbers on the whiteboard and go to an Excel sheet. So this is Nandi, 50 million. Okay. So I'll put growth rate here. Gentlemen, in this world of business, Excel is your friend. You just have to understand Excel. You don't have a choice. Can you see my screen? Are you seeing the Excel sheet?
Yes, sir.
Okay. So let's call this year 1. So I see the only number and Violet that are following me. I want to show everybody else is with me. Who else is here? Please shout here.
Hello, sir.
Okay.
Yes, sir.
Hear you.
Yes, sir.
Thank you. I hear you. So let's say this is Nandi's. I hope this formula makes sense, right? Now I'm going to use a dollar sign and freeze this so that it doesn't move. That's another whole education, gentlemen. Okay, so this is Nandi's initial 50 million, and we're agreeing that it is growing by 30% every year. So year 1 is 65 million. If it keeps growing like that every year, if it's investing the money, it's not eating it, it's just investing the money. In 10 years, Nnamdi will have gotten 530 million. That makes sense, right?
Yes.
Good. I'm saying not that to say that organic growth is not bad. So for a company growing at 30%, you can conveniently say that there are multiple. I'm going somewhere with what I'm trying to show you. There are multiple in 10 years. I call this 10-year multiple. Assuming they keep investing out their money. You can see that 10-year multiple is 530 million divided by 50, right? That's about 10, right? That makes sense. True or false?
Yes.
Let's say 11. Let me just say 11. But assuming this company is not growing at 30%, assuming it's growing at 20%, let me just say 25%. What's the 10-year multiple? It's about 7, right? Does it make sense? I'm looking at year 10 and comparing to year 1. Does it make sense? If I say 7. Hello, people. Are you with me?
Yes, sir.
Yes, sir.
Now, can you see what I'm doing? Does it make sense?
Yes, sir.
So if a company is doing 20% margin, what is the 10-year multiple? I should give an answer. So I know that you are with me. 10-year multiple for a 20% rate of returns investment on a company. What is the 10-year multiple?
5.
Thank you. Yeah, with me, Farida. So let's say the company is doing 15%. Let's say what the 10-year multiple.
Like 3.5.
Thank you, Farida. Perfect. 3.5. So you could see that 15% rate of returns and 30% rate of returns are huge. The difference is massive, right?
Yeah.
Fantastic. Very huge difference. Now, this company cannot be the same. They're not performing at the same level. So, but I just said all that to show that this is a company that wants to grow by organic growth, just reinvesting the money they are making. This company is growing. Like, this is Nnamdi's company. Nnamdi is shrewd. Nnamdi is not trying to conquer the whole world in one day. It's just like, oh, I don't want to take debt. I don't want to take equity. I just want to just be growing my business and be going gradually. God is my strength. I don't take debt, that kind of stuff. And Nnamdi, in 10 years' time, Nnamdi will go from 50 million to 175 million. Not bad. Not bad. But remember what we showed earlier, that if Nnamdi took a loan, at say 20%, if you remember our last mathematics, that if Nnamdi took a loan at 20%, his returns on investment would increase to 40, Abi?
Yes.
Yes, thank you for remembering that. So even Nnamdi was taking a loan at 20% every year, Nnamdi's multiple will increase. We'll have some person that are stopping our noise, our peace. I have to. Deborah, you're not doing your job, but Deborah, mute the noisemakers. Okay. And Richard.
No, sir, I'm not a co-host. That's why, sir.
Okay.
But if they miss you, how would we? We won't hear anybody. Then.
No. I said you should mute the noisemakers, not me. Let me make Deborah co-host. Okay. Justina is muted. Okay. Now, do you want to say something now? I see your hands are raised.
No, that's not.
Oh, okay, before. So you guys remember now that we said earlier that if this guy took a debt of 20%, Abi, that it would increase his return on investment
to 40.
To 40, and his multiple will now become what now? What's the figure now? What's the figure now? The figure will now be remember you're losing me, Farida. What will now be the 10-year multiple now?
Yeah.
About 21.
21?
Yes, because he's not going to make a billion.
Okay.
But this is on the assumption. Remember, this year one is able to get 50 million, right? And
yes.
And he grew by 40% to get 70. But he can only grow by 40% again if he gets up to 70 million, right?
Yes.
So you know what? He's reinvesting at the same rate. He's reinvesting all his profits. So by just taking a good loan at 20% for 10 years, he's able to grow his multiple from 11 times to 21 times. In other words, instead of being a 500 million naira man in 10 years, you'll be a 1 billion naira man in 10 years. That's the power of debt. Does this make sense, anyone? Hello?
Yes, sir.
It does.
Now, this is on the premise that he's reinvesting that money.
Yes.
Because you could as well throw a party, marry a second wife, travel abroad, buy a house. You know, these are all options available to him. But he could say, no, I want to reinvest, I want to reinvest, I want to reinvest. And he keeps reinvesting it. And all of a sudden, he becomes a billionaire in 10 years. That is perhaps the best that debt can do for him, because debt is still limited by his ability to do what? To provide collateral.
Collateral, yeah.
Yes. That is why we're coming back to our subject matter, which is equity financing. Any questions before we continue? I wanted to give us an example of what debt can, what equity can do. Let me complete that example. Hold on. Okay. Okay. So we're discussing Namde, and we've shown from the mathematics that, you know, if it takes loan, it can go at up to if it takes loan, it can grow at up to 2 times, 20 times, right? If it does, if you just reinvest profits, that is, if you organic growth without taking a loan, it can grow at 10x, right? Ordinarily might say, I want to grow more than this. And all this is 10 years, though. This is 10 years, assuming that the monies are invested. 10 years more. And you can say, I want to grow more than this. I want to get more, build more assets. We said he can build out his assets either by reinvesting profit, which is what we just looked at, or by taking other people's money. So alternative to building asset base is by taking investments, which is where the subject of venture financing or equity financing comes in. We're looking at how does Namdi Limited convince family and friends, angel investors, and venture financiers to put money on him However, note, this consideration should always be made in light of the fact that He could as well have taken debt. Do you understand?
Mm.
So how do you convert to instead of debt? So it means that whenever we are discussing venture financing, you should bear in your mind that a decision was made not to take debt. So at every point in time, the decision is debt or equity. And certain things are involved once we are discussing this. One, something that will come to mind. I don't know why I'm not getting used to this yet. Okay. One is the rates, because even equity has rates. Abi?
Okay.
No. If somebody is giving you money, the person is, what they call returns on equity. This is called interest rates. But return on equity is how much that person that is giving you the money is expecting to make. It may not be today, it might be in 1 year's time, it might be in 10 years, but that person has, an expectation. That return on equity is always from foregone alternatives. And level of risk. You must factor this whenever you're talking about foregone alternatives. Now, what are those foregone alternatives? Now, you remember the bond, the corporate bonds. This is federal government. The fixed deposits. Abi? True or false? These are foregone alternatives, right? People, are you with me?
Yes.
So it means that, and this is 14%, right? This is about 13%. It's about 8%. So it means that anytime you're taking somebody who is giving you the money has forgone these options. And the person is still bearing a level of risk. So it means that the minimum returns on equity the person is expecting, minimum, is 14% plus risk. Friday, does this make sense?
Yes, sir.
Thank you. So this person is expecting 14% minimum because it was what I bought government bond. And this is 14% for this per annum expectation, minimum. So that tells you that sometimes you don't need equity. Because if somebody can give you like that, Dangote got 11% interest rate. If he has the assets for it, it has a low rate, what do you need equity for?
Okay.
So Dangote was able to get as asset to characterize it. It now has also a low rate, doesn't need equity. But let's say Dangote needs, let's say Nnamdi now needs 200 million to expand. Nnamdi on a pharmacy shop. He wants to build something like H-Medix in Abuja. So if he takes 50 million, which is the best he can take from a bank, it's still not up to 100 million to start. He needs 200 million. Does not have the asset for it. Because if he had assets, he would have gotten maybe the bank, they know him, they can give him 20%, which is lower than what Nelson might ask of him, assuming he came to Nelson to take a loan. So to take an investment, Nelson can ask for equity. So now that's now for somebody that can give him assets for him to be able to do that HMD. But Nnamdi has to also make a decision to say, how much equity do I need? Do you get? But Nnamdi can say, I have 50 million. I need equity of, let's say, 80 million. for example, so that I now have 130 million equity. So I can now take loan of 100 million. Does that make sense?
Yes, sir.
So when we're discussing equity financing, I don't want it to just be taken as if it's just equity versus debt. No. It is just another financing option. I must be made from the perspective of pros and cons. So if I need 200 million, so if I take the whole 200 million as equity, it might dilute my shareholding. The person coming to me for 100, 200 million might be bringing the 200 million, might be asking for too much, right?
Yes, sir.
But if I take 80 million from the person, which we are almost equal, it depends on how I define the equity though. I can now take a conventional bank debt of 100 million, which is based on my asset base. That way, I still have the 200 million I need to start the new project, rather than taking everything on equity. Now, apart from rates and assets, the other thing that is also important in considering when you're making these decisions is the patient's future. What do I mean by patient's future? If somebody takes a debt, you have to start paying that interest immediately, right?
Yeah.
So interest is immediate in debt. So if Dangote takes the 11.6%, it means that every month they are paying 11.6% divided by 12 as coupon rates or discount rates on that money. It's a monthly payment. So interest is immediate, but equity, you don't need to pay returns on an immediate level. You pay returns at the end of financial year, or as agreed in the investment document. But debt, you have to start paying. So if now this time set up HMDs, and HMDs will not start paying money immediately, now they might say, this 100 million, can we pay the debt? Let's say this 100 million might be at 20%, for example. Remember, we are trying to use examples so that it can make sense to us. So this 100 million debt, now I'm just considering now, might yield 20 million as interest, Abby, which is 20 million. Then we can say, my existing business makes 15 million naira, Abby, per annum. At least this new business in the first 1 year should at least make 5 million, Abby, minimum. Now we can say, I think I can cover the interest payments. Go ahead. But if this business cannot make this 20 million interest payments, now they should reduce the debt and take more equity. Why? Because the debt is not patient. Does that make sense?
Yes, sir.
Okay, good. So Nnamdi needs to increase his asset base by taking equity, but he needs to make sure that the equity is not too much so that it doesn't lose out on the benefits of debt, But once he's mixing debt and equity, he wants also ensure that the debt is such that he can always pay the interest on the debt through the cash flow of the business. Nnamdi is juggling many things at the same time. He wants assets, but doesn't want to take too much assets. He wants some mixture of debt. That is why companies will always have debt on their balance sheets, because sometimes debt is cheaper. In fact, many times debt is cheaper, but you need to have some measure of equity to get the debt. Okay, let us progress. Like I keep saying again, this is just preliminary knowledge, but this knowledge is enough to save you in the evil day. Just that you should know that this is not enough. It's just for you to know what it takes to run a business, make better decisions, and read more. So in debt, there's a collateral, you pay interest. In equity, you pay profits. And debt is usually short duration. Equity is usually longer. Debt can be short, but when a corporate debt like Dangote, it can be long. It behaves almost like equity. Sometimes a debt can be made to behave like equity, but we'll get there. A debt does not participate in the profit of the business. Let me say what I mean by that. If I give you a debt, if a bank gives you debt, a bank only charges their profit, their interest rates. Whether you make money or you don't make money, if you made 10 times what you projected, the bank will only take their interest rates. In other words, the bank does not participate in the profit of the business. That makes sense, right? Good. Equity participates because equity is a shareholder. Debt does not share your risk. That is why debt is always collateralized. Equity shares your risk. In debt, the risk is low, which is why you must have a collateral. In equity, the debt is high because there's often no collateral. In debt, the returns are low and fixed, lower than equity. In equity, returns are high and variable. Okay. Now, with this few background we just mentioned, so equity financing or venture financing is not a partnership. So if somebody is investing money in you, it's not your partner. It's not a business partnership. Because in a partnership, when I say partner, I'm using the legal term for partnership, right? Because in partnership, the instrument of partnership is the partnership agreement. But in equity financing or venture financing, the shares is the unit of ownership.
Okay.
Equity financing is not secured. There are no collaterals, hence no guarantee. It is not time limited. It is not certain. It is not liquid. It is not suitable for core investment. In other words, it can be risky. So sometimes, let's say you have your father's mortgage, your father has retired, and they paid him 30 million as his gratuity. You don't get that 30 million and put in, an equity investment. You might lose it all. I have a friend, when we were pharmacists growing up, I'm still a pharmacist. As a pharmacy student, we were about to finish. I was about to launch a pharmacy business then. Then the guy was about to invest. He wanted to invest money, and that was his father's, pension or gratuity. So I thought that let me start the business first. Let it be stable. When I'm sure of our operational costs and all that, I cannot take the investment and open the next shop. So when I was telling my friend to wait for me, let me be sure of the next steps. My friend invested that money in his friend who was doing what do they call it now? All this trading, forex trading, and more like an equity investment. More like I buy a share of your forex trading business. And they lost the money. Now my friend is bitter. So this is my father's pension. This is my father's pension. I asked him, is it a debt or an equity? What? Did the person say, give me this 5 million, I'll be giving you this number of money every month? If that is the case, the next question is this: what is the instrument of the debt? Is it a debt agreement that you signed? If it's not a debt agreement, is it enforceable? Because by law, you are not a debt granting institution. Do you get my point? People make this kind of mistakes every day. If you give your friend a debt and your friend says, I'm going to pay you, this was it, percentage every month. For all intents and purposes, that is a gentleman agreement. Do you understand? It is not enforceable by law because you are not a debt granting institution. Does that make sense?
Yes, sir.
Now, but assuming you have a shareholders agreement where the person gives you a share of the company, law, and in that share of the company, the person says this company, this shareholding is eligible to this number of this returns on investment per annum. Now you have a legal contract. But people make this mistake all the time. And that is why even if you carry the person to EFCC, it's not enforceable because you have a gentlemanly agreement and you don't have the right instrument of debt and right instrument of recovery. So I just said that venture financing is not so for core investments because it's risky. If you're investing in somebody else's business, or somebody else is investing in your business, it's risky. So question is, why venture financing? Why do people need to take venture investment? Because many times you need to increase your asset base. Many times you need to share in the thrills of a business. You need to share in the returns on a business. And the only way to share, to participate in that returns is to take equity stake. And you do that only because you believe in that dream, you believe in that vision, you believe in that project. Where the person is taking the debt as a public debt, like Dangote issuing stock holding, or taking the debt, taking the equity as private, like Mr. Nnamdi asking me to invest in his company. In both cases, we are having a leap of faith. We are taking a leap of faith in trying to grow our business, right? Okay. Fantastic. So let us continue. Venture financing is simply a businessman asking someone else or a group of persons with deeper pockets than him to come along for the ride with no guarantees. There are many purposes of financing: to initiate trading, to change market position, to change event ownership, to get a strategic partner. These are different reasons why people take debt financing. Now, why are we talking about equity financing a lot? The reason why we're talking about it a lot is that we are in a knowledge economy. Knowledge products will define the face of the market of today and tomorrow. And those knowledge products are not physical assets. They are not bankable many times. A good idea, no matter how good it is, no bank will give you money on a good idea. So good ideas rule the world, but good ideas are not bankable. Hello?
Yes, sir.
Hi.
Thank you. Good ideas rule the world. Thank you, sir. Good ideas rule the world, but good ideas are not bankable by themselves, which is why equity financing is critical, because good ideas are not bankable. That is a big consideration. So you have a very good idea, done a software, yes, fantastic. It will make so much money, but the bank cannot hold it as a collateral. So the bank cannot give you debt. So you have to come and start looking for equity. So why do you need to understand this? Because you will need equity financing. Your ideas need financing. And you need to know how to get it. It has worked everywhere else. It generates 20% of American jobs. Every big company you know today, Tesla, Microsoft, Facebook, Google, they are all products of equity financing because they are knowledge economy, they are knowledge businesses, and you don't do knowledge business by assets, physical assets. They are based on intellectual assets. So, however, beyond money, you also need the advice of those who have gone ahead of you. So when we go to our physical sessions, we used to watch a lot of
Shark Tank.
Yeah, Shark Tank. Thank you very much. It's a lot of Shark Tanks. So, Mr. Wonder, I'll give you the assignment to share Shark Tank on the platform. We have plenty videos of Shark Tank, just share on the platform so people can watch. That in those Shark Tank videos, you see that a lot of times somebody can come to the tank to raise money simply because he wants someone else to advise him. Doesn't need the money. He just needs an extra pair of eyes.
Subject matter expert. Yes, sir.
Subject matter expert. Someone that can make phone calls that they'll pick his call. Let me give an example. I have a very good software that can solve Nigeria's insecurity issue, right? I can track Boko Haram with that software. I've developed it, I've built the model, right? But I don't know the NDA commandant. I don't know the generals that will buy it. And it's a public, it's for the government. Private sector people will not buy it, right? Now, I have 5 potential investors. One is a former general. One is a police officer. One is a billionaire in Nigeria that made his money from selling fish. The other one is a trader in Anambra State, but he also has billions. Who do you think is my best partner for that investment? Hello?
So can you come again, please?
I have a software that can help solve Nigeria's insecurity challenges.
Yes, sir.
Fantastic software. But my goal is to sell it to the military people.
Okay.
I've built the software. I have enough money. I have up to 100 million naira to deploy the software. So money is not my challenge.
Okay.
However, I don't have access to the general, the powers that be, the people in security, this thing. So I want to take an investment. And I have 4 options of people who want to invest. One is a former general who has some money. One is a billionaire in Anambra State as a trader. The other one is a billionaire that made his money from fishing, from selling fish. The other person is also a politician, but also has billions. Question, who is my best partner?
The general.
Thank you. The general that has a little money, simply because he knows who to call.
Yes.
So beyond money, I can be looking for venture financing just to get experienced people. I can give another example. As a business person, I'm producing processed foods that can be sold in supermarkets. I do kulikuli, I do cashew nuts, I do different packaged products, right? Let's say I have some money of my own, but I need more money. I have potential investors. One of them is a businessman on the chart that made his money from selling rice. The other person is a politician that has billions. The other person owns a stake in ShopRite. Who is my best potential investor?
I think the one that owns has a stake in ShopRite.
Thank you. Even though they might give me the same amount of money, the ShopRite person can convince ShopRite to sell my products. That is what you call strategic partnership. So all money are not equal. Some are more equal than the others. Does that make sense?
Yes, sir.
Yeah. So when people are considering people investments, so let me give an example. Now, do you know Ike Onyechi?
Go back to the shop. Yeah. Oh.
Huh? Now, do you know Ike Onyechi in pharmacy sector?
No, no, sir.
Have you heard of Alpha Pharmacy?
Yes, I have.
Okay, Ikonyechi is the owner of Alpha Pharmacy.
Okay.
So for me now, a pharmacist in the pharmaceutical space, if I want to do anything big, I would likely go to Ikonyechi and say, sir, what do you think? If he says, fantastic idea, I will start it. Then I'll also ask him, sir, would you want to invest? Even if it's 5%, I'll gladly have him invest because he can make phone calls and call people that I cannot call, right? He can tell people, tell to that guy, it's my boy. To give an example, when I went to pharmacy in Lagos, Ikoyeshi told some people, give him credit, and they gave me credit of up to ₦1 million. Now, imagine that my store, I did have up to ₦2 million worth of goods, and ₦1 million of that goods was credit. So in other words, they gave me loan without going to bank. You get? That's the supply credit. By just telling them, I know that guy is my boy, give him goods. So imagine if he even owned a stake in my company.
Wow.
Do you get? Imagine I gave him some stake in the company. So beyond money, sometimes you need people who have what you don't have. So you want to ask them to take some stake in your business. So you could go to business angels, you go to angel networks, you should go to venture capital funds. These people are different. Business angels, like I described earlier, are human beings who like to invest in other people's business. Angel networks are a group of the same human beings who like to invest in other people's business. Venture capital funds are specialist businesses that have money looking for where to invest. And if you meet them and you convince them, they can give you money. So I want to stop here for now. Let's take some break and ask some questions. Thank you. Questions? Anyone? Or observations? Any question, observation? Okay, Mr. Stephen, you're raising your hand.
Yes. Good evening, sir.
Good evening.
Okay. So I just want to, sorry to digress. I want to know the difference between commercial papers used by companies and funds.
Okay. Now, it's just terminology. Commercial paper is debenture. Hello?
Hello, sir.
Hi.
Yeah, a commercial paper, that's the debenture we've been talking about since.
Okay.
Yeah, so a bond is like a generic word. So when you say commercial paper, it's a kind of bond, but for corporate organizations. Do you understand?
I understand, sir.
So a government cannot issue commercial paper. You know, and commercial papers are like treasury bills for private sector. They're like let's just call them short-term debentures, short-term private bonds. Does that make sense?
It does,
a short-term. So, for example, now that Dangote 10-year bond is not a commercial paper. That Dangote 10-year bond is not a commercial paper because it's 10 years. Hello? Hello?
I'm following, sir.
You can't hear. It's noisy.
Okay. So I was saying that long-term loan bond that Dangote issued is not a commercial paper. That's a longer term. It's too long. That's a bond. That's a corporate bond. Or call it a debenture. So bonds are generic words. Bond is just like saying a more like a registered loan. Do you understand? So bond is a generic word for a registered loan. So I could say bond. It could mean private bond. It could mean government bonds, right? But once I say treasury bills, I'm referring to a kind of bond. That makes sense, right?
No, sir.
Thank you. So when you use the word bond, it's a generic word. It can mean private or public. But when you say commercial paper, when you say debentures, you are referring specifically to private sector. And when you say treasury bills or treasury bonds, you are referring specifically to public issued instruments. Any other questions, observations, comments? Anyone? So can we take 10 minutes break? Let's just drink water, stretch our legs, and then we'll come back and continue. Thank you.
Okay.
So by 6:30, we're continuing.
Let me use personal experience now to also drive home. I love that slide where he said one of the advantage of venture financing, is that they share risk with you. And when so the same way, when it goes the other way too, let me use a personal experience. I also worked in the banking sector, and I know we don't care. If you like, tell us, immediately the bank gave you the money, this one happened, that one happened, business went down, bank will still come after you and collect the money. That's why it's called debt. Bank will still, in fact, I've seen a case where it was government that was owing contractors. Government owing contractors. We all knew about it. It was all in the news that government is owing and all of that. But bank did not. When you go to customer, they will be giving you newspaper and showing you, this thing was even reported. We let them know. Okay, yes, we are aware. We are aware, but we too, we have a management that is after us, that we have to recover this money. So that is one of the disadvantages of debt. But I want to share one experience on what venture financing actually means. Myself and a group of people, we wanted to organize a seminar. So we are putting some money, but we discovered that we will actually need much more for some preparation and all of that if we are to actually go far. And we approached this man to actually borrow. We actually wanted to borrow. I remember back then, I think what we wanted to borrow was probably 500,000 or thereabout, or 1 million. And when we got to the man saw our proposal. The man said, that he will not borrow us money, he will be part of the business. Because he saw what we said we are going to be making. The man said, no. I'm talking of a registered finance house now. That they are doing investment, banking and all of that. The man said, no, we are not going to borrow you. We are going to be part of this. The man said we should go back and do a proper estimate of what we need. Well, some of what we wanted to do then before, let's just take this money. Then some of us are still expecting money from one place or the other. We will now have it. So it's okay. Since this man is ready to partner with us, let's forget what we are going to be getting. So the man said, okay, I'm going to have 25% of your. Okay, initially it started with 20%. So we drag it. Okay, from 25%, we drag it. We agreed 20% of the money of the profits, because it's just one-off program. After the program, all of us will just share and we move on. A day before the conference, it was a conference actually. A day before the conference, we needed to actually get additional 1.5 million or 1 million to be able to do certain things. We told the man, okay, let's get this 1 million, but it will not be part, this one will be a debt. It will not be part of the business. I said, no, stop doing debt. We should increase his stake in the business. We should increase the stake in the business. So he dragged for additional 5%. It's okay. My other colleague said, this man is too greedy, as I see. The risk, bro, Nelson asked one question. He said, someone, if the bond, if Dangote is giving his bond at 20%, what should you do? I mean, if you are giving somebody money, you have to give the person higher percentage, because the higher the risk, the higher the return. So that's what it should be. So I told my other people, I said, see, this man is taking a lot of risk. No collateral, nothing, and is part of the investment. So we should not look at what, because everybody's now thinking that, wow, 20% off before. Now another percentage is also going to be, off again and all of that. I said, well, to cut the long story short, something happened. It was supposed to be a telecoms conference, and everybody, MTN, Glo, everybody planned to be there. But the only problem is that they are going to pay. They want to be sure that the conference will hold. There's a lot of people have done that before. They will give them money. They will not organize. So they will, once they come and discover that it's running, they will pay. Unfortunately, that was the thing coincided with the day Nitel will be sold for the first time. That they, when they wanted to what they call it again now, when they wanted to do, Nitel used to be public, enterprise, and they wanted to,
yes,
yes, exactly. So that was the day they needed to actually do the launching. So all the people that will come for our conference needed to be at that other one, because that other one is more important than our. At the end of the day, we could not even yes, we made money, but not, now after the conference, we look at the money that we've made, and the man said we need to remove his own money first. Then we said, sir, this is an investment. You have 30% of this investment. So after deducting all the costs, then we'll come back and your 30% will be given to you. The man said no. Because if you are giving that 30%, that 30% will not cover his cost. It will not cover his investment. And the thing led to EFCC issue. And they told him point blank, where is the agreement between you guys? Where are the share, And they look at it, they say, sir, if this guy can look at you and say, okay, on a moral ground or on a compassionate ground, and say, okay, we want to, have a kind of concession, it's different. But if it's based on this agreement, these people offer no, is investment that you wanted. And that is what saved us. Because we would have, after one, we would have first given all the money that we made to him first. Then we will still be indebted to him. So it's important for us to be able to analyze the kind of business we want to do. More importantly, let's look at the risk, because sincerely, there is no business that doesn't have, no matter how small it is or how little it is. So when we look at the risk side of it, sometimes we may just, agree that you need to share this risk. Then you think something here is, let me go with some other people to do this. And like Brother said, in fact, he captured everything. If, before we reach the conference thing, the man always on our neck, you people should come and present this one. I need the report on this one. I need, it's because you are no longer, so you have to look at all of that. If you know you are someone that is a control freak, as in you don't want anybody to, you don't want anybody, just want to be, there's this concept of a cash or king. Which one do you want? You just want to deliver nothing, you just want your cash. You know, so these are kind of thing that is a very, very, you know, important. Thank you very much. Sorry for wasting more time, but I just think.
No problem, sir. That's a very, very good analogy, because people need to understand that. And thanks for that. I'm going to even use that model to share more thoughts, because there's no need hurrying. Folks are not getting the point. So let's kind of take it a bit slower. So for what he said, there's two things to note. And people often make that mistake, that a business has revenue, has cost, and there's a difference between revenue and cost as the profit, have you? Right? Hello?
Yes, it is.
Most times your investment is here. The investment you are making is here. Now, the mistake that person made is that the shareholders agreement, which if he had made them that offer, they would have agreed, would have protected him if he was able to separate both, separate the investment and ring-fence the investment, such that you know, he would be like the first person to take. So, for example, how he would have structured it, because that is part of what we're going to arrive at eventually in this conversation, how to structure investments, is to say they needed, let's say, 10 million, and he's bringing 2.5 million, right? So they are bringing 7.5 million. For example, this is the cost of the business. The business was going to make, let's say, 20 million revenue, cost. So profit of 10 million, right? So if the business didn't make 10 million, didn't make revenue of 10 million, if they just made 10 million naira, there would be no revenue. In which case, anybody that invested will at least not lose their money. This is where risk management comes in. Knowing these fundamentals first, to know what is your break-even point, at what is the minimum? 10 million. We must make 10 million. So the person knows that this business must make 10 million. So let's say in their case, I don't know how much he brought. Let's say he brought, because it's most likely that he brought a larger sum. Most likely they brought.
Yes, it did. The larger sum, yeah.
Exactly. So they brought 30 million, for example. He invested 70. So, but because they're the ones doing the bulk of the work, okay, let me just call it for ease. Let me call it 3 million and 7 million. So most likely they brought 3 million and he brought 7 million. But because they're the ones doing the bulk of the work, and because they were expecting, like, let's say 50 million, for example, so profit of 40 million. So he already did the maths and said, if I make 25% of this, which is 10 million, I'm still fine. So based on this, he went ahead without checking the risk that if they made 30 million and the profit became 20 million, at 25% is at a loss. So this investor did not look at the risk threshold of this business, which urban people don't look at. They tell you MMM, they give you 30%. What is the risk? What are they going to do with the money? They will look at the returns and then now lose your mind, you know? What would the person do with the money? So
sorry, bro Nelson. Actually, yes. Is what you just said. Now, you know, sometimes we also benchmark. without necessarily knowing intricacies. What actually happened? The son of the man is the person that the son is also the person who appraised the facility. So when the son took it, it was the son. Okay, this is what happened. They usually call the son. Who I think was the banker there. They will call him, okay, you want to appraise the facility. So when he saw it, said, Daddy, you remember so person in our church. They did the one for energy and they made so much money. That is what we see. And the man said, so it was the son. When I said that, and now they are doing telecoms. Telecoms is also, it was this it was during the Obasanjo time that everything was just coming up, telecom just coming up, energy, everything just coming up. Have you forgotten? So this one too will even be bigger. Without not even looking at it from point of they are not the same. Not the same. For instance, the energy was talking about, it was even the minister that even wanted to help the person who has to go and do the conference and insisted that you A, B, C, D will support this conference. Unlike we that we did not actually know anybody. Just a lot has been said by I believe this is I mean this lecture. I'm not even talking about this particular part. There are a lot of things that Okwonna mentioned, especially when he was talking about the Shark Tank, that I want us to go back and listen to over and over. When he was mentioning the example of a general, honestly, he said so that maybe one of the mistakes we made probably wasn't even the money. I mean, was the maybe I would say maybe instead of even looking for the money, then we would have actually looked for who will actually guarantee because
the project itself.
Yes, project itself. If we probably try to get the buy-in of someone in the ministry, the person will have been able to tell us, this day that you people picked, we are selling. You have been able to all the efforts that we are using to go to MTN, to go to, it was Econet back then, Econet, go to Glow to get this thing. The man will we don't need to be going. All the money on the flights won't be necessary. The man will just call somebody in MTN and say, these are my boys, they are doing this conference. It's going to help everybody. So that is another lesson too. One of the mistakes we also made, and the mistake those people also made, is not this threshold is very important to actually look at the threshold of, if you think, okay, 3 million is fine for me, multiply by 3. Understand? You don't just sit at multiply it by like 3. So that if you don't, because like you said, the structuring of the agreement in the first place, I also learned from this. After this one, there are a lot of other similar arrangements that clients will call me and say, okay, we want to do this. But because I also, had similar experience in this, I'll say, okay, you know what? Tell these people that you need 5%. And what you are giving them is still the debt.
Yes. Yes. So in this case, for example,
so that's
sorry, sir. In this case now, for example, sorry, sir.
Continue.
In this case now, for example, assuming the person did debt, that's 7 million at a low interest rate, and now negotiate equity at a lower rate, let's say 15%. You guys would have given him happily.
Because
you would have given him happily.
That's the truth.
So even though it was the same amount of money he brought, by just not structuring it right, he had lost huge money. And as an entrepreneur, you should know this difference, because this is what makes amass many businesses. Debt structuring. You are getting 7 million either way, but how do you structure it? So now, in this case, the investor got a bad deal. It could have been you, the entrepreneur. You understand? Because if, for example, he took this offer and he made 50 million, he still get his 7 million back, and he only make profit of 50% of this. This is about 6 million. He make 13 million, which is still fine, almost double his money, right? Good. You guys will make the rest. But now you've given him security, Abi, of his funds.
Yeah.
And then an upside. But he went for the full money and lost security. So as a good investor, as a good entrepreneur, we always recommend offer your clients, in this case, your investors, security, and then an upside on success. So I give an example on our real estate investments. So my partner invested initial 35 million. So we agreed that we'll treat this as debt at 1.6%, even though it's equity. Do you understand? So we treat it at 1.6x in 3 years. So we said in 3 years, we'll pay you 56 million, Abi, and still give you 40% of profit. Do you understand? Now, I was bringing some money myself. We said that money, we also treat that same money the same way. Do you get? And give myself 60% of profit because I was managing the business. Do you get? Over time, the client invested an extra 30 million in the project itself. So by giving him more like security on his finance, he knows that if anything goes wrong, our 2 investments should be pulled out first before profit is even mentioned. Do you understand? In this case, 56 million and 16 million. So we treated our own cash as debt to the business, and then we share profit if there's a profit. Hello?
Hello, sir.
Hello, does this make sense?
Does, sir.
Yes, sir, it does.
So financial structuring is amazing. That is why this lecture is going to end up by saying that you must have what we call the 3 M's.
Yes, sir.
The 3 M's of venture finance. 1, you should understand the market. Good management. Again, good mathematics. That is the structuring. That's why we tell people 3 years is enough for you to be proficient at management. If you are proficient at management in 3 years, you have the market by coming to EMP and mathematics. You can go anywhere in the world and tell people and show somebody how you can take 100 million. Do you understand? Because there's always ways to multiply 100 million to 300 million. Once you have a good management, Abi. But what people need to see, what most people are looking for, is that management telling them, I'll give you security on the 100 million. This security is not security as a collateral security. You understand? And then we share profit. It's not collateral security. It is basically saying that the 100 million we take first, which is what did not happen in this particular case study that we just heard. Do you understand?
Yes, sir.
So imagine, for example, that they had costed their service and gotten the 100 million to pay for it. Now that becomes staff of the business, and pay themselves maybe 1 million for their effort or 2 million for their effort, which the man can carry. He won't mind, and then I tell him he will take first. So that way, even though the business, let's say, flopped and made only 7 million, because they have already been paid in a way, at least for their transportation and all that, he takes 7 million, he knows, okay, he has gotten at least all the money available in the business. They still have a good relationship. Next year, they can try another one. But when you don't provide security for your partner, for your investors, even though they may not ask for it, what happens is that when it goes south and they lose money, you can survive, but you may not have a repeat business. I'm sure Mr. Jide, you're not able to do business with that guy again.
Of course, we, like you said, relationship is very, very key. Once you start taking yourself to EFCC, so once, and before that time, we actually done 1 or 2 things with them because they are financials. So it's that one that now actually spoiled the whole thing. But we try to learn, as Christians, try to still make friends and all that. But that trust is not. The last people call me, it's okay. We should still bring more business. This one, that one. That trust is not just there. So because I didn't expect him, because this thing was clear, I particularly pleaded with him and said, no, this is what we need. Understand? Just give us the ways you have been giving us the loan before. Other people will also bring. He said, no, we will only do it if you put part of it. That's okay, no problem. Go ahead. And even the last one was even the one that really paid me. Paid me in the sense that I couldn't get his money. That's what I'm saying. Because me, I was just, it wasn't just my own business. They just called me and said, okay, come and part of this. So the only thing I did was actually take the finance house. So whichever way, I cannot be happy that I took those people to the people that gave them money, and so both parties are my own people. So I'm not affected the relationship badly. That's the truth. And that's why I like this point you put there, that good relationship is everything.
Yes.
Relationship is everything beyond money, beyond and that must be protected at all times.
So, ladies and gentlemen, we just gave a class on financial structuring, and it is, you don't understand. You don't understand what we're saying now. You don't understand, but you understand later. This can be different between life and death. Someone can kill you for this. That man to EFCC can as well have shot them. True or false?
True.
Look at that. Some people will say nonsense. Do you know who we are dealing with? You are dealing with me. I'm the king of boys in this city. Give him a bullet.
So, which is also coming down to the fact that even from beginning too, character is very important. Character is very, very important when you are choosing when you are choosing who you are dealing with as well. Even when they are investor, they have all the money. Nothing stops you to have a background check. Because some people want to actually twist you. Understand? So they will do anything. So it's also important to know that these people you are dealing with, they are just interested in in growth. Just interested in how many, especially when you see people asking you about exit, is very good. When people tell you that you just what is your exit? If I want to exit in 2-3 years, because some of them just want to do it and say, okay, we are part of this. We're able, it doesn't matter if you make 20 billion later, but they just love is that success story that is actually important. So they just want to move from you to another person that is just coming up. So it's important. When you see serial people that are just serial investors, these are good people to go with. So not just people that are just desperate and all that. So it's important when somebody asks you, my own strategy is to invest for 3 years. So some of them, if you cannot If they can't exit in 3 years, they may not invest in the money. Some with 5 years. If they cannot exit in 5 years, they may not invest. Or if they cannot see how they can exit. It doesn't mean they will exit eventually, but at least just want that window.
Yeah.
There. Thank you.
Thank you very much, sir. Wow, I don't even know how far we can go today, but I think these stories help to cement the thought material. Any question before we continue? Okay, so we said that it may not be for you. Don't forget that. What I mean by here, the business is not you. What I mean by that is that there's a difference between you and the business, and it's also very important to note that. For example, when you say in this case, like in this particular case, that you treat the money coming in as debt, and then let the person take first, and then cost your services. You might look at, oh, what do you have? What stake do you have? You know, you might start feeling that personal, but don't forget that you are treating the money as if the money is employing you and you're sharing the profit. So which is why the likes of Facebook and Zuckerberg, Facebook, Apple are able to raise tons of money. It's because they have learned how to create structures that protect their investors. So go and read up these guys. Read up Peter Thiel. Peter Thiel invested the first $500,000 in Facebook. By the time he made this investment, $500,000, dollars was at 160 naira. You know, that's about 80 million. I tell people then that my father had 80 million naira then. You know, so my father would have invested 80 million in Facebook. would have invested 80 million naira in Facebook. I don't know if you get my analogy. So Peter Thiel invested in Facebook. Let me get the exact year. Look at the exact way he made that investment. So what else can also help me check? So not too long ago. So in other words, not too long ago, Mark Zuckerberg didn't have $500,000. I want to use that as a to close today's session. We cannot finish today, but can somebody give me the time when Peter Thiel made that investment in Facebook, please? Any fast finger? Mr. Peter Thiel.
2004.
2004.
Yes, sir.
So 18 years ago, Mark Zuckerberg did not have $500,000. How much does he have now?
Over $70 billion.
$70 billion. That's multiple of 140, ba? No, multiple of 140,000. Sorry. Yes, now, right? Multiple of 140,000. Yes, that's what it is. From 500,000 to 70 billion. Oh, God. Multiple of 140,000. So how do you do that? That's the magic of venture financing, gentlemen. That is the magic of venture financing and the stock markets. We're going to discuss stock market, don't worry. I have a long way to go in our talk on finance. But that is how you cook the food, man. So how did he do it? So what we're going to discuss next. He did that by understanding these three things. the mathematics, the market, and the management. Because he understood that the market can grow at infinity, which is how the tech market, which is why tech, everybody's looking at tech. Tech market can grow at infinity. It can go to 1 million times. If you are serving 3 million persons, you can serve 3 billion persons. You know, if you are serving, I thought he was investing, what was Facebook number, the population, people on Facebook in 2004. Anybody can help us get that. Facebook's figure 2004. So he could estimate the market reach, he could estimate the numbers they could make on that market and all that. So he was able to negotiate for finance. Because once you understand the market, you can negotiate for financing. So I don't know the terms of this deal, but if Zuckerberg, for example, offered him a secured returns on the investment and reduced his equity, because this is security on investment, this is also a structure. It depends what they call, we'll get to that, what they call participating shares. We'll get to that. So where you say, for example, now if you're giving $500,000, this business will be paying 5% or 10% per annum on this $500,000, and this can be converted to shareholding in XYZ. There are many ways to structure it, but by structuring it properly, if he secures this money in a way from earnings, from potential new earnings of the business, he may not give out so much equity. So let me repeat that in another language. If somebody comes to me and says, Nelson, I need, okay, let's say I have 10 million of my own, for example. I think I've even given that case study where, because I had 10 million of my own, I was raising 35 plus 30 million eventually, So even though this looks like 6 times what I had, right? But by providing a fixed returns on this money that is above market rate, I was still able to negotiate for 60% of the business, right? That makes sense, right? Does that make sense?
Yes, I does.
Yeah. So, but if I had said, oh, total money is 75 million, let's share equity based on how much you brought, I'll be getting like 10%, right? So that is structure. You don't do that. People want to minimize risk because there was no guarantee that this money was going to come back. So you secure it. When you secure it, so someone has confidence to give you whatever you want. So imagine this business made 1 billion, for example, right? I still would have paid this 65 million, maybe 120 million, right? True or false? True. The remaining 880 million, I still have 6% of it, which is about 540 million. So I would have grown by times 54. I don't know if you get my thinking. Hello?
Hi.
So by securing the money, not from an asset, not from a collateral asset, mind you, but from future cash flow. So when you don't have collateral assets for debt financing, investment financing, what you're negotiating with is what? Future cash flow. So based on future cash flow, you want to now provide that level of security. This is an advice, level of security for the equity where possible, because mind you, you have nothing to lose, because what the investor can do is to take back the money he invested, right? Abi, that's all you will lose. And that money is taken not from your capital, your cash, but from the future earnings of the business. If there's no future earnings, then there's nothing. So And you can also do that level of equity for your own investment too. Do you understand? For the equity, including yours. So Facebook could have said, okay, you're bringing $500,000, for example. Everything I've brought is worth 5 million in terms of sweat equity now. So normally it should worth 10%. Me, I should 90%. But Facebook can still say that I won't give you 90%, 10%. I will still pay you 20% on your 500,000 per annum. And then when I've paid you 3 times your money, I'll give you 2% of the company. And still maintain at 8%. It is still having a good deal for Tata here because you are still gotten 3 times his money and still get 2% of the business. Do you understand? So he has no risk. He has beat the market, and he still has 2% of a big company. That is negotiation. But you cannot do that if you don't know the mathematics. So before you offer a client or an investor equity percentage, before you start discussing percentages, know how much will the business make. Do you understand? It is based on what it will make that you can even start designing a structure of what you can finance, of what you can offer. I think I should stop here. We can continue tomorrow, even though I was thinking of teaching something else tomorrow. But tomorrow we can discuss mathematics, markets, management, exit strategies. We'll discuss some case studies in share public offering. We can even go ahead and discuss public offering well. We'll discuss MTN Nigeria was able to raise capital, money for Capital Alliance in 2001. And they made 42.5x on MTN. ABC Transport was able to raise money from Capital Alliance. Swift Network was able to raise money. Some case studies, you advise to watch on Shark Tanks. We discuss the process, where to find investor, the key factors to note, considerations in investors, what a proposal should contain, how to structure the deal, which is what we're already discussing now, and preference shares is what I just discussed about how you can have a share that is earning a return on investment, which is what if that man that partnered with Mr. Jide did, it would have been a better place. He would have had a preference share where his preference share would take first, and have earning fixed returns. Even though it's a share, it's still behaving like a debt, but they didn't do that. And, other issues for considerations. So before I go, let us not forget that this course is brought to you by Heart and Heart Foundation, and we are delivering this from a Christian perspective. Our goal is to raise men and women who would represent God in the marketplace, and who would raise leaders that represent Christ in the marketplace, who would, shine the light in a dark world and be agents of change. However, you cannot be agents of change if you don't master the rudiments of the game, right? You cannot be agents of change if you don't be like Daniel and spend 3 years learning the language of the Chaldeans, You cannot excel at what you don't even have knowledge about. So, which is why we're having these sessions, and this is just preliminary, and we expect you to go and read more. So Facebook had 1 million users at 2004. So you could see that between that 2004 and today, they have about 3 to 4 billion. So that's about 30,000 times. So about 3,000 times. So you could see the number. You could see that his estimation made a lot of sense. So you could see the relationship. So gentlemen and ladies, I don't know if we have made progress today. Any questions, observations, comments before we go? Any questions, observation? Mr. Steven, I didn't know your daddy. Any questions before we go? Comments? people of God, am I talking to myself since?
No, you're not. Good evening.
You're not talking to yourself, sir.
Oh, encourage me now.
It's wonderful. Like everything I've done so far is mind blowing. I'll see it early, so we still have to do more within that. Like you recommended, and that I will believe we will do that. I will do that.
You're welcome, Richard.
Thank you. Thank you very much.
Thank you, sir. I really appreciate the more we interact, I realize there's so many things I really don't know, and so many things most people around me don't know either. But the good thing about the knowledge is, once I pen down things and make effort to check up on them, I see there's even so many more things to discover and learn about, and that, just like you said earlier, hard work is really not enough. There has to be strategy. There has to be enough knowledge.
Welcome.
You're welcome. Really enjoying the session, sir. Really enjoyed it. I now understood why at times God will not release some level of breakthrough to us until we have increased our capacity to take some levels of breakthrough, because at times you'll be like, I'm supposed to be controlling this kind of finance by now, but your knowledge base cannot sustain it, so it might kill or put one in danger. So exactly. I really appreciate you, sir, for exposing us to this broad knowledge.
You're welcome, Stephen. Thank you.
Thank you.
Okay, John.
Thank you for the class. I've always had interest in equity financing, but I think
we lost Mr. Wonder, or is it just me?
No, not.
This will still give me a lot of insight.
No, sir.
Okay. Thank you, Mr. Wonder. Thank you, everyone else. Please, my joy will be complete if we have at least 20 persons in this meeting. So that, because it's the same effort to teach 7 persons that is taken to teach 20 persons, right?
Yes,
so right
sir.
now we have just 6 persons in class. Just 6, 1, 2, 3, 4, 5, 6. Okay, 7 persons in class. And our goal was to have at least 50 persons in class, but even if it's just 20 persons, it will be worth it. So please, I'm not saying that it is not worth it teaching you. I'm happy to teach you, and I'm happy our resource persons are also happy to teach you. But I promised the resource persons that we'll have at least 20 persons in class, because their fear and mine was that if the effort will be worth it. And like Mr. Jide said, what we're teaching is no less than what we get paid for, far more to teach. Earlier this year, I paid Mr. Taffa 150,000 to do a 2-hour session, and myself, I was even paid more than that. Mr. Miracle, one of the people are going to speak, I paid him the same amount. This was with Abeg. So 150,000, and Rotimi too, we paid him about the same amount, 150,000 for 2-hour session for like 5 days. So I'm just saying all that to say that you are getting the best, and the least you can do for us is to talk to your friends and family. Those do need to be here, so that we know that we're talking to a body of believers, and that what God has asked us to do, that we're achieving it, right? It's coming at a huge cost, and I want you to make the most of it. Thank you very much. And thank you, Mr. Jide Olai. You guys don't know who Jide is, but one day you will know. Thank you, sir, for being here.
Thank you very much, sir.
You're welcome.
It's always my pleasure being here, honestly.
Thank you, sir. Thank you, sir.
Thank you, Bro Nancy, for doing this.
You're welcome.
I should be saying thank you to you. It's not the only way to actually encourage him is to bring more people. Honestly, he's doing so much, and believe me, he has been consistent over the time. His passion is something else. Believe me, his passion is is something like today when I insisted that I must, even if it's remaining 2 minutes before this session will finish, I will join. You know? And sincerely, I'm happy I did join virtually. Thank you. God bless you.
God bless
Thank you, sir.
Thank you all. God bless you all. Bye for now.
You too, sir. Thank you.
Thank you, sir.